All right, welcome to the Nadex Application and Strategy webinar series. My name is Daryl Martin, and I'm with apexinvesting.com. I'm a trader, just like you are. Trade every day in the markets on Nadex. And today we're going to talk about Nadex binaries. Before we get going, we're going to talk about, throw up the disclosures here, let you see them all. You know, there's disclaimers, etc. Basically, at the end of the day, trading involves risk. It may not be suitable for everybody. Your decisions are your own. This is not a recommendation for what you should or should not do. You have to make your own decisions. Okay, so just like in any area of investing or trading, that's how it works. And then the next thing is we put up the standard risk disclosure, which is futures, options, swaps, trading. All that involves risk. May not be suitable again for every investor. Any trading decision you're on, it's like basically just a double page there almost. But the bottom line here is that you cannot lose more than what's in your account at Nadex. You won't see that as part of the disclaimer here. You're not going to go in and get a call saying you owe a whole bunch of money because you traded some sort of highly over-margined instrument, and now you owe a bunch of cash. That doesn't happen on Nadex because your risk is completely capped. Okay? So with that being said, first thing is I actually want to take you over to Nadex and get you going there, because like I said, some of y'all don't even have a demo yet. So what do you do to get a demo? What do you do to get that demo extended? Hop on over to nadex.com, okay? And I would do this right now. So while you're on the webinar, go to trading, go to demo trading account, and click on that link there. Fill in your username, your first name, and I'll put it up right here. So username, your first name, your last name, the password, and hit apply for a demo. So again, that's nadex.com. Click on trading and demo trading account, and that'll get you all set up. And what they'll do is they'll send you an email, and you'll be able to log in right away. And once you log in, the next tip I got for you is go ahead and change your password to a secure password that you're going to remember, because there's a good chance that you're going to forget whatever password it is that they give you. Okay, and we know how that goes. It's hard enough to remember all the passwords that you get out there, and just so you don't forget how to log in, in the next day. When you log in, they're going to give you $25,000 of funny money that you can play with, and so you can trade risk-free. In the demo account, you can learn, you can make mistakes, you can learn how the platform works, you can put all the different pieces together, okay? And this is what it'll look like when you log in. If you want to update your account, just go to My Account, you go over here to Settings, and you can go to Preferences, you can go to Password, right there, you can put in the one they gave you, and you can update that. One of the preferences, like you might want to say, default contract sizes, you can turn that on to update that. It's a really cool new feature they've just added in. A lot of people don't know about that feature. So I wanted to make sure you were aware of it. But again, it's a new one they're adding in, and it's really nice because if you trade on Nadex, you're going to be like, I always got to choose the size, right? So now you actually can automatically let it choose the size for you. And they added this into demo, and they're going to be adding it into live hopefully soon. But they're always adding in more features. So basically, the way this works is if you go in there and you choose, say, you want your default size to be 2, and you hit Set Preferences, then ideally, once you've done that, you can go over here. We'll close out our preferences, and you can click on a contract, and it automatically had the size filled in for you. So they put that in demo. They launch things in demo. They test them out once they're working. So yeah, that was like always having to add that size in. So now we have that on our scanner automatically as well. We invented that idea first, I guess, right? So the scanner is built around what do we want, and so that's automatically on the scanner as well, which is free for you to use, and you can use that on live right away. But that's where you go for that. Now, what about where to get more information? Okay, we're going to be going, through some more advanced stuff today. You want to get your basics down. Where do you go? Hop on over to apexinvesting.com right here. Just apexinvesting.com. and then click Get Free Access. Free account, no card, nothing. A lot of stuff you can try out. A lot of education. It's lifetime membership access to a lot of tools that you can use directly on Nadex. And then just log in to your account. Once you log in, then you're going to see a few things. One of those is you're going to see education. We have courses. We're adding more and more courses in. And we'll be adding like quizzes and certifications and step by step how to get charts set up, like underlying actual charts, real platforms, real data feeds for free. All that's under the courses. Also, if you go over to the Nadex tutorials, this is where if you're new especially, and even if you think you're not new, like you've traded binaries somewhere else, you're still new, okay? You're ahead of the game, but you're still new, and there's a lot of differences. And it is worth your time to watch these 15-minute videos to help you master the platform, understand Nadex, know what the binaries are and how they work. If you want to get in the spreads, there's videos there. They are totally different instruments. They are not alike at all, okay? And understand, what is a tick and what is a pip and how does that work and what is Forex and what is futures and, so like the contract specs. This sort of gets you started and you have a really good broad base of information. And then we'll also post webinars under here under webinar recordings. So you'll be able to see that again, education, webinar, and then webinar recordings. Bonus webinars 3, I think, is where this will go. We post also in the forum, and we send them out on our Twitter feed. So if you're following us on Twitter or on YouTube, then you'll get a notification when we upload new courses and new videos. And then right here, you got the trading question forum. If you click on that, this is really useful because you're going to have all sorts of questions come up and trying to figure things out. And so I really recommend that you go in and learn how to use the forum so that you can ask questions about anything related to trading. So Nadex, how futures work, Forex works, just all those different pieces that you're going to want to put together. And then the one other piece that I'm going to bring you over to is right here on the scanner. So we'll be looking and referencing this today because this will help you, because if you're scalping, you don't have time to be clicking around all these different expirations to find the best contract. In fact, you're going to show you a couple techniques today that are really cool and a lot different than what you maybe have ever thought of. It's almost backwards on a couple things I'm going to teach you today. And it's really hard to do this without having all the contracts listed on the same page. Without having to, if you have to click around, it's going to be real difficult. So you get access to this for free. And you come over here, we got all the markets feeding in. And it'll tell you when they're open and closed. It'll show, you can log in, demo live. You can open tickets directly, right here. You can choose demo or live at the top. You can set your default quantity. You can even say I want in the money or out of the money or at the money contracts, or I want them to have this much time or not more than this amount of time until expiration. I only want to buy or I only want to sell. And what I tell people is don't get caught up in the filters. Like choose live or demo, choose default quantity, and skip the filters. Because what you're going to do is you're going to come down and you're going to go, okay, I want to trade US yen. Okay? And one of my favorite instruments to trade at night is because the strikes are so narrow. They're only 5 pips wide. And so it's easier to find a contract for your trade whenever you get a signal from your chart. When your chart says, hey, when this happens and this happens, I buy. So it's easier to find one that qualifies. And so once you know what you want, you're like, well, I only want to buy. I don't want to sell. I'm just going long right now. Okay, well, then I click buy. That drops the sells off. And, well, I'm not buying stuff that's out of the money. Like that basically means, and we'll talk about what out of the money means here in a second. I only want stuff that's in the money. Well, I click that right there, and now I can see all the contracts that are in the money over the next, in this case, 3 days. Okay? And it's like just a few that actually qualify. So, that meet all those requirements that I want. And, buy side in the money, and it really narrows it down versus going over to the platform. You're like, okay, I want to trade Forex, I want to trade US yen. Okay, so now let's start going through and scrolling through here. And I'm like, okay, well, that one's in the money. Okay, that one's in the money. Okay, that one and that one. Let's see here. Okay, there's a few there. There's one right there. You know, it's like scrolling through all this stuff to try to figure it out can be, and then remembering what you saw and the price still being there by the time you get back. I mean, that can cost you $5 or $10 just by clicking back and forth. And that's if you're only trading one instrument. You know, what if you have 4 different charts if you're trading 4 different instruments? So scalping is about speed, okay, to a certain extent. And it's not, I mean, we're not talking like hyper scalping, okay, where you're going in and out, in and out, in and out, in seconds. But, I mean, sometimes. But, you know, you don't want to be wasting your time finding contracts. You want to be focusing on your charts so you're not missing trading opportunities, okay? All right, so yes, I will answer all the questions. So we're going to go through real quick, and let me show you the topics for tonight. And so we're going to talk about how is a binary value determined? And so we're going to talk about a little about the pricing of a binary, what in the money, at the money, out of the money is, but also like what affects that. When does a binary move the fastest? When does it move the slowest? And one of the techniques I'll show you is maybe you just want to trade directionally, but you don't want time value to be a part of it, and you want a lower risk trade. How could you do that? I'll show you that tonight a little bit. And we'll talk about how to scalp. Mainly, we're going to talk about scalping intraday and daily binary contracts. I'll talk about even when doing in the money, how to try to maintain a 1-to-1 risk to reward ratio. And you need to use a few things when you're trading. I don't care what system you're using. If you're actively trading, you need to be looking at price action along with volume and movement expectations. And so we'll look at a few examples of putting that together. Let's see here. All right, so I got a few comments right here and questions. Yep, traded today. All trades were winning trades. Well, awesome job. Way to go, David. That's awesome. Change your vote to above average. All right, Andrew, you are bumped up. And Troy asks, can you ask a question? So I'm going to knock this out, and then I'm going to dive in. Can you answer this? If you enter a binary and it closes in the money, but you haven't covered your point spread, it says, do you still win? I would say, are you still profitable? So you want to get that win-loss out of your head and think profitable, not profitable. A little less emotional. Okay, so yeah, actually, I think I sort of need to redefine that for you to help you out. And no mistake at all. I'm giving advice in the sense of the more I can remove those emotional terms from my trading, the better I am at trading. So, if the binary closes in the money, you will get full payout, which will be your risk and whatever the max profit is put together. It doesn't matter about covering. I'm not quite sure what you mean by point spread. Maybe you mean bid-offer spread, is my guess. But yeah, that doesn't matter. So now, would you still be profitable? It may depend upon your fees. So if you're going to buy something at $99 and you have $1.80 in fees, it's not going to do you a lot of good, right? So, because you're going to lose 80 cents after your fees. So, you have to look at all those pieces together. But yeah, you don't have to cover the bid-ask spread. It just has to be in the money for it to get full payouts, I guess would be more what you're asking. All right, so let's talk about real quick just what a binary is. And to do that, I'll pull up a binary chart. That makes sense, right? So let me grab a binary chart over here, and I will show you this. You may not even have known you can do this. It's pretty cool. Let's say we're going in and we're looking at, U.S. yen, okay? And on the U.S. yen, we're looking at the most current expiration we can get. By the way, if you're in the platform, you have to remember to hit refresh every hour, or otherwise you won't drop the old ones and you won't see the new ones. The scanner will automatically upload them for you. But if you're over here, we go into this, and we can click on here, and we can see what the quotes currently are. The market has not moved at all. that actually can be good because we can learn a little bit from this. Because I bet this has been going for about an hour and 20 minutes. So there should have been more value at the beginning with the market being literally just flat for the last hour and a half. And so you can go to this little right-click button here and click Quick Chart. That'll show you a chart of the binary. Honestly, you're probably not going to reference this that often, okay? And when you do this, then you want to make sure you have like mid. If you're looking at a spread contract or a binary contract, make sure you choose mid, not bid or ask or last or whatever. Now, bid or ask are good for if you want to see like what was the sell price, what was the buy price, okay? I usually just put it as mid unless I'm literally trying to see did it hit a certain price. And now we're going to go over here. We're going to tighten this up a little bit down to like minutes. Okay, so it didn't really move a whole lot, right? We can see that right there. I mean, if you would have bought it, it would have cost about 94, and it's about up to 94 on the bid side there. It's moving up a little bit. Not a whole lot of activity. I'd like to get you a better example. Let's see what's that, the 102.40. Let's try the 102.45. That might work a little better. It's a little closer. There we go. That's a whole lot better. Okay, that's perfect. All right. So, a binary contract. When you buy, now this is the most basic definition, okay? This is not where you should end in what your thought of what a binary is. And you shouldn't trade binaries like this. When you buy a binary, you are stating that it will expire greater than the price. You're basically stating that the statement is the name of the contract here, is true. The US yen will be greater than 102.45 at 8 p.m. Okay? You don't have to hold it. That's not how it has to work. But the first thing to understand is that is what you're stating. When you buy, you're saying that statement's true. Greater than 102.45 at 8 p.m. Okay? And if it is greater than 102.45 at 8 p.m., then you'll be profitable in the trade and you'll get maximum payout, which is $100 settlement payout per contract. Okay? So if I buy the binary contract for $70 and I get a payout of 100, and this is can sort of mess you up a little bit when you're new. What was my profit on the trade? Because remember, the maximum value of a binary is 100. Notice how this chart isn't really going higher than 100. Okay? Right there. What is my actual profit? Not accounting for, fees. What's my profit? So yeah, Robert, Michael, Kenny, perfect. So $30. Okay, so that's the most I can make. $30 on the contract. If I bought a contract for $10 and it expired greater than the strike, the price right here, the US yen itself, that's what you're saying. The US yen, spot FX pair, the settlement price as of 8 o'clock Eastern time, everything's on Eastern time, will be greater than 102.45. So if you state that and you bought it for $10, how much would you make on the trade? 90, perfect. Yeah, Greg, excellent job. So Kenny, Michael, Robert, knocking it out. There you go. So $90 is what you would make on the trade. So huge profit. Okay? That's a big move usually. Usually. We'll talk about some of those usuallys and not so usuals that you might be able to get them on small movements. Okay? So just understand that when you buy a binary, the price you buy for is the risk. So if I buy for 10, I'm risking 10. If I buy for 90, I'm risking 90. If I buy for 50, I'm risking 50. Okay? $100 minus that is the max profit potential on the trade. So you'll notice if I go over here and I click on this contract here, then, and let's say I paid $10 for it even. Let's put it right at that. Notice how it says max loss 10, max profit 90. It'll always add up to $100. Every time. Now, if I go in and I have two contracts, it'll add up to 200, 300. You can go whatever. Okay? So there's a lot there that you can look at. But it's really important that you understand just that simple thing. When I buy, do I want to sell higher or sell lower? And I know this sounds really obvious, but people get confused when we go to the other side. If I want to buy low and I want to sell high, right? Buy low, sell high. Any questions on that? Now, again, I could buy at 10. Now, could I sell at 40 if it moves up? Or if I bought this over here, if I bought it a little bit, earlier, if I would have bought it over here at $75 when it popped up to $90, could I have got out of the trade? As long as the price was there? Yeah, I can get right out of the trade. I don't have to hold on for the last $10, the last $5. Be amazed how much that last $5 or $10 can cost you. I had a trade today on oil that we were doing. We got in like at 57 on the trade, and the last few minutes, this thing's just sitting like 48, 52, 48, 52. We've all been there. Flies up to like $90. Get out of the trade. Flies down to $45. Within like the next 30 seconds. And then in the next few minutes, flies back up and does expire in the money. I was more than happy for us to get out at $90. Right? So, why risk it? So that is your profit if you take it. Do you want to give it back? And, one of the things one of my mentors taught me was that I always wish I have something I don't, as have something I wish I didn't. And I think that it's a statement that every binary trader could definitely hold to heart, okay? Because you hold right into that expiration, and you're like, oh, man, I wish I just had a $40 profit and I wasn't dealing with this last 2 minutes, and da-da-da-da, okay? And then you get stuck with it and it goes out of the money. So if it's close, you got to really ask yourself, is it really worth it? Or should I just move on to the next trade, okay? Or if it's moved a majority of your profit target, is it really worth holding on all the way? Okay, and this is really, as a scalp trader, you are planning on exiting. Okay, that's part of what a scalp trader does. They get in a trade and they get out of a trade. Tell me something else. If I went over here, and this goes back to scalp trading, pardon me, and I bought right here at, let's just say 75, and I sold over here at 90. I made $15, right? Okay, that's not huge. If I held on, I made 25. That sounds pretty good. Except for you held all the way to expiration. What did it cost me? Let's just say I was remaining bullish on the trade. What did it cost me to hold on to this trade? Did it actually cost me money to do that? So the answer is yes. You actually tied up $75 in capital, $75 in risk, if you held on to it, where you could not get out and find another trade. Well, let's say you bought over here at 75, and it went up to 90 and you exited the trade, and then it dropped back down to 75 again, and ran up to 90 and you exited the trade. Not necessarily a horrible idea, right? So I've had trades where I've actually got in and out of trades like 4 times within 5 minutes. Like boom, in, boom, boom. And by getting out, I freed up my cash. Or it was flying up. And like just because of the way that the binary pricing was working, it was like basically at 90, 91, 92. It was sort of like holding there, right? Because like the market was moving so fast. And I had a choice. Wait on for this $8 that's left in this trade. Or go grab the next one that I can buy for 50 and make 30 or 40 on that one, and then go buy the next one, and then go buy the next one, and just keep riding the market up. Don't tie up all my capital for $8 more when I could go make 20, 30, 40 more on another trade. And I'm not talking about over trading, okay, but I'm talking about you got to look at cost of lost opportunity by tying up capital waiting for a few more bucks. Like, well, my risk-reward ratio, I'm like, yeah, I get all that. But what is it really costing you to have that good stat you put on your Excel sheet? Okay? You have the risk. It comes down. You may not get a signal to go back long. It may fly against you. Okay? You do get another signal to go back long. Let's just say the second one does lose. Okay? You got out. Second one loses. Well, you made $15 here. It goes down. That reduced your, obviously you still lost that money, but you had $15 you just made to help cover part of that loss on that next entry. So there's a lot of you got to really start thinking about as a scalp trader. It's like you're getting in, you're getting out of the market. This is also really important if you don't have a lot of time to trade. Okay, are you going to sit there and wait? I mean, look at this thing. It went from 90, and it didn't really get to 100 till pretty much now. I mean, about 95, 98. And really, I mean, you can get out at 92, right? So the most you're going to get, by the way, is 94 to get out of this trade. So for $4 more, you waited from 627 for pretty much the peak right here at 928 or 728. So you waited a whole another hour to make $4, and you made 15 in 25 minutes. Versus looking for other opportunities that you could make in another 15 or 20 or 25 minutes. Okay? So I'm just trying to get you to think about that lost opportunity cost. And again, not the point of over trading. I'm not trying to get you to go there, but I'm trying to get you to think about, what am I costing myself? Am I really hanging out for $4 more? Am I worth $4 an hour? Am I worth more than that? Right? So it's like, okay, 15. Maybe I made that in 15 minutes. Okay, payday, good. You get on this trade, it starts moving up. Payday, good. Next trade. So what are you being paid an hour to be sitting there? And it's really a weird, almost uncomfortable thought. As you get to trading, you really start thinking about your hourly rate. So now the cool thing about trading is you can increase your quantity as you increase your account size and as you practice proper risk management, and you can exponentially, not infinitely, but you can, compound that, where you could have done 10 contracts and made $250 in the same 30-minute period. You can't really do that on a job. So, and you can't make it where you can make 2,500 or 25,000 or whatever, depending upon the size that you're trading. So it's really important to understand that cost when you're looking at scalping. So yeah, Cameron. Oh, awesome. Yeah, Cameron. I know. Yeah. Says he done the USN this morning. Got in, got out, got in, got out. Yeah. So, and then let's see here. Something else you need to be very aware of as a binary trader or scalp trader, either way. You need to look at, this is demo. If we go to live, we'll look at the same thing over here. Let me put my live account up. And it'd be usually about the same. I mean, there's traders in demo that can affect the market, right? So it's 72.75 by 81.50. It's actually because there's a market maker in here. But if I go click on that ticket, I'll actually see more depth, I bet, than I'll see over here. Yeah, see that? So we're actually getting a little better bid-ask spread. I was actually noticing that today with the bid-ask spread jumping around and them competing. But you need to notice, what is the best price I can get out at, that I should expect to get out at? Okay? Like 94? What's going to happen if you say I want to sell at 96? What do you think is going to happen on your contract? Could you get filled? Is it possible? So let me show you what's going to happen. You're going to say, I want to sell at $96. Okay? You're going to hit place order, and it's going to become the offer. And until somebody's willing to pay $96, your order's just going to sit there. Okay? And it cracks me up because I'll see people come in and they're like, man, I'll sell it for $99.75. Right? That's what they're putting in there. Well, yeah, I bet you will. Okay? So I'll sell it for a quarter of risk. And they hit place order. Okay? If somebody takes that trade, the most they can make is 25 cents, and they got to pay all their fees. They're going to lose money guaranteed. So I feel sorry for them if they do. They need to attend some of our webinars. But you are placing an unrealistic order that is most likely not going to get filled, and you're not helping yourself. So you need to be realistic about when you look at prices as what should I expect to actually be able to get out at. And like that's the most I really should be able to expect to get my sell filled at. Okay? Now, a comment just came up, and same thing on the buy side. So, if I'm selling first, we'll talk about that, and I buy back, okay, buy back at 6. Okay, that's the least I should expect to be able to, get out. I shouldn't be like having to buy back at 4. And that's market by market, expiration by expiration. You've got to look at the price ladder and see what the realistic expectation is. And usually, depending on how much time there is till expiration, and how many contracts there are and everything else, I usually go for like one worse than that. Like, let's say there was a 94 and a 90. Like, that's 5 more ticks the market doesn't have to move and I get filled. I'll take the 90, So you got to really start looking at this to help you determine your exit price. Otherwise, you're going to have unrealistic exit prices. You're going to wonder why you never get filled. Now, a comment came up, is it just me or have the market makers been trading? Yeah, the market makers, plural. Okay, they've added on market makers. You may have noticed that. You see it going on right here. See this? Okay, these are 2 different market makers. Okay, 20, 100, 20, 100. And so they'll flip back and forth, which means they're competing inside that bid-ask spread, which is really cool. That's what we as traders want. We want them to be competing for our business. And like I was noticing here on oil when I was looking at this today, to seeing like it get tighter and tighter, go back and forth. Like right there, it was $1 wide. Okay, $1.50 wide on the bid-ask spread. And that was 2 market makers, 198 by 25. Because they're trying to get filled. They're trying to unload the other side of their order. Their job is not to trade against you. It's to take your trade and get rid of it. Okay, they want to be delta neutral, which means they basically want to buy at the bid and they want to sell at the offer and be out of the trade. And so they're competing to jump in front to get rid of that other side of the trade. And so you'll see that more and more as more traders come on and more market makers come on. Then we're really going to be able to see that nice tightening of the bid-ask spread occasion, which is really, really cool. And that means more liquidity, more contracts, tighter bid-ask spreads. It also means you need to pay attention when you see the size. Like, see how we see like 2100 over here? Don't think that 20 means 20 is all there is. You can click on the ticket and you can see the depth. You can see the 100. Okay? So there may be more than one there. Just like if I go over here and I place an order right here for one at 96. I'll sell one at 99. Okay? Actually, that's not a good place. Let's do it over here where there's like 100 contracts. So I'll sell one at 75. Okay, which means somebody else could buy it from me at 75. And I hit place order. I'm now the best price available. It's basically fill or reveal is the rule. Okay? So either the market maker has to fill me or they have to reveal my price to the market. And it's instant, as you can see. So I have the best price. It's going to show the best price and the quantity available at that price. It doesn't mean that's all the quantity available. So, right, there's 100 more contracts available, $3 more. Okay? Just I have to take profit in there. So be aware of that. That's, a couple little tips you need to be aware of. Now let's flip it over. Let's look at the sell side. If I go over here to the sell side and I sell a contract, I'm saying this statement is false. Really simple. Okay, statement is false. That means that US yen will not be greater than 102.50 at 8 p.m. So, if the US yen expired at 102.50, was I profitable if I bought, or was I profitable if I sold? What if it expired right at 102.50? If it expired right at 102.50, we got a few orders coming in. That's good. Or a few questions coming in. Or comments. Answers. Get the right word eventually. Okay, if I sold, I was profitable. Okay? If I sold, I was profitable. So, that's awesome. It means that it was at or below, right? Because at or below would mean not above. And I mean like 1/10 of a tick. If it's 102.501, which is why you'll actually see in the indicative pricing here, they round it on out there for you. And they round it down to the final settlement, round it to that last tick. Okay, 1/10 of a tick above 102.50 would be in the money for a buy. So this is something that came up a lot this week with some new traders that came on, and it's helping them learn this. Who can tell me if this contract right here is in the money or out of the money? Okay, when y'all answer, we're getting right and wrong answers, and that's why I'm asking this, because this is a really good question. I never realized. All right, so I'm going to give everybody a chance to answer. What do you think it is? Is that contract in the money or out of the money? All right. Anybody else want to take a shot at it? I won't call you out. Okay. What was the question? Is the contract in the money or out of the money? It's both. Every contract is in the money and out of the money, depending upon whether or not you're a buyer or a seller. Okay? So, if you're a buyer, then let's look at the indicative. And that's when somebody said, show me the indicative. There you go. Well, the indicative is 102.49. Well, is it greater than the price? No. So it's out of the money. Because remember, when you're saying buy, you're saying that statement's true, or is going to be true at expiration at least. So right now, as of this moment, if the market didn't move at all, it would expire out of the money. It's an out of the money buy. But is it less than? Is 102.49 there less than 102.55? Yes. So if you're selling, if you just say it won't be greater than, it'll be less than or equal to, it's a sell. So it's an in the money for a short, it's an out of the money for a buy. Same thing if I go, this isn't the best one because we don't have I guess we can make a bid offer, right? We'll make one. We'll do 5 of them. Here we go. Make our own market. Okay, so 102.45. Is it in the money or out of the money? It's both. Is that right? Is it both? No, I'm talking about the order I put on. I just put that on to, have a price on the offer and sell side. So yeah, it's right now 102.50 is the price. It's greater than 102.45. So therefore, if I'm buying, it's in the money. It's already greater than the strike price. If I'm selling, it's less than or equal to, it's out of the money. And this sort of trips people up when they first come on. So that's why I'm trying to go over it with you. And I didn't realize this literally until just this week. And I've taught, I think, 6,000 traders now. And so, just the whole, in the money, like every contract is both in the money and out of the money. At expiration, is that contract removing the direction from it? Okay. So the contract just itself, at expiration, it's both in the money and out of the money. Okay? So it's both. It's an in the money for the buyer, it's an out of the money for the seller. If it were to expire, if the market, the US yen, were to expire at 102.50, or really any price greater than 102.45. Okay? At 8 o'clock. And that's why you'd see seller payout 0, buyer payout 100. All right, so on the sell side, I'm saying we got that down. And just to confirm, you got down the whole how does take profit work on the sell side, because you want to make money in both directions. You don't want to leave half the market out. If I sell, the price I sell for is my maximum profit potential. Okay? That price minus $100 is my maximum risk on the trade. So if I sell for $94, how much can I make on the trade? What's my profit if I sold this contract right now for $94? What would I make? If it expired in the money. Yeah. If I sold it for $94, I'd actually make $94 if it expired in the money. I'd risk $6. Okay? So this is where it can sort of trip you up when you're looking at the sell side. Okay? When I buy, the price is my risk. Okay? $100 minus that is my max profit. When I sell, the price is my max profit. So it's inverted. Max loss on buy side if I'm buying. If I'm selling, the bid price is my max profit on the trade. So that minus $100 would equal my max loss. So $94 minus 100 would be -6. Max loss $6. So if I sold for $94 and I wanted to make $6, what would I buy back at? $88. There you go. Okay? So sell high, buy low. Buy high, buy low, sell high. So it doesn't matter whether you're buying for 20 and selling at 80, or you're selling at 80 and buying back at 20. You can do them in either order. It doesn't matter. Okay? In the end, it's the same thing. So, and people have a hard time with this because they're like, everybody's used to, you buy first. Well, maybe. You may take an order. I mean, think about a business. A business takes an order over the phone. They get a bunch of pre-orders in for the newest video game that's going to come out. Okay? People give them money, whether it be full payment or they take a down payment or whatever it is. They sell it first, okay? And then they buy it from, Xbox or whoever's making the game at a lower price. They sold the game for $50, they bought it for $40. They sold first, they bought second. Okay? It's like a pre-order. So think of that, like, that's when you say short, you're saying, I'm going to go ahead and sell it first, I'm going to buy it back, hopefully cheaper, lower. Whenever I got my wedding rings made, a little over 10 years ago, and the jeweler that made them for us, we designed our own rings, and got them made in platinum, and she sold us the rings. She quoted us the price. She looked at the current price of platinum and quoted us the price of the ring. And then she was waiting on some things to come in. She didn't get around to buying the metal. And platinum almost doubled in price. Yeah, oops. And she ate it. Because she quoted, she already sold it to us. Okay? And she lost money on, one of the rings because of that. And she's okay. So, but that's sort of like trading. If you sell it, and it may go higher when you buy it back. So, but that's an example of a short sold contract that, went against you. So, just trying to help you, mentally grasp selling first, buying second. Okay? Once you get that down, it doesn't matter. Okay? You're like, I don't care. I just want to sell high. I want to buy low. I want to buy low. I want to sell high. Either way, I want there to be a difference between the two, and I want that to be in my favor. Everybody got that down? Feel good? Hopefully you understand shorts more than ever before. Okay? Because I know that can be one of the biggest sticking points. All right. So, we got that. And let's see here. I'm also going to try to grab this chart before it closes out. Get a couple of these charts going. And I'm going to grab a chart of, let's look at a US yen chart real quick, an actual US yen chart. Okay, so right here, this will be a good example to really display this whole idea of scalping, because you can scalp a few different things in binaries. People don't know this. There's actually 3 things you can scalp in binaries. Not only can you scalp movement, like I buy at 20 and I sell at 40 or, whatever. Implied volatility can come into the market, which means like expected move. When do you think the binaries might get more expensive? When do you think that's like? And I mean, just like the market doesn't move and they get more expensive. When do you think that might happen? No, not during expiration. Right before news. Exactly, Greg. So before news, they'll actually get more expensive. I did some trades on the air, some big news trades. I've done them like, because I have a radio show I do every day, and a lot of times I'll call live trades out on the show, and I'll do them right there. And I've literally put on a strangle, which is where you buy the one above and you sell the one below. Like I bought a 6 and I sold a 94. And I've literally seen both sides become profitable. And the market hasn't even moved yet. And I'm actually up on my bought and my sold. That's because implied volatility came into the market. So you could actually scalp implied volatility. You get in before a big expected move, and you got to learn that little implied volatility curve, but you can learn it if you watch, okay? And you'll get that timing down. You'll see this pop up, and instead of staying in, you're like, I'll take my free money and walk away. That'd be a scalp. You obviously can scalp movement in price, and you can scalp time. Just simple time decay. So let's look at a good example of time decay. Right over here, we got the market quoting at 101.51, and pretty much in the same period over here, 101.51. And so, like, we're looking at like 1955. And okay, so I'll go over here and I'll pull up, 5-minute charts. Let's get as close as we can here. Then I'll reload everything. And so we go over here to 1935, okay, 1936, whatever. And then we go over here. Here's what I want you to notice. Okay, price came back down to where we were at. But let's look at this current little 5-minute bar. Came down here. We're only like at, let's see, what is the high of that bar? 1951. We're only a tick different. One pip, one little bitty pip of movement from where we were, 20 minutes ago about, okay? Yet the contract has went from a value of 60 to a value of 96 on one pip of movement. Where else are you going to do that, okay? So that's time value. Why? Because the binary has to expire at a value of either 100 or 0 at expiration. And this will also trip people up because they think of settlement payout and expiration value of the binary being the same thing, and it's not. See, a binary right here, if I sell it at 94, and let's say it expires, and this is one of those sort of, can't be a trick question, but I really encourage you to answer it. If I sell it at 94, and let's say the market does expire down at 102.40, okay? What did the binary expire at? Because it's in the money, right? So if I sold it, it's in the money. What did the binary expire at? I got a settlement payout of $100. But if I sold at 94 and my expiration value was 100, then how much did I make? Yeah, see, it's sort of confusing, right? So if I sold at 94, basically it settled out at 0 because I was risking $6 by selling at 94. I could make up to 94. The binary expired worthless because notice the binary itself is always a true statement. It's always a greater than. You may say that's not going to be true, but itself is always a true statement. If that statement is true, it is going to be expiration value of 100 or expiration value of 0. So if it expires underneath the price, it expired at 0, which means I sold at 94, I bought back, essentially it settled out at 0, I made $94. I put up $6 risk and they gave me a $100 payout. Okay? So basically I got to sell it, all this like shorting a stock down to 0. That's what you're doing. Okay? If it went all the way to 0, you shorted it down to 0. Okay? Does that make sense? I know that's a little bit of a mind bender the first time you hear it, but the payout is $100 because you got back your $6 of risk, you got back your $94 of profit. But you can't make 94 if you sell something at 94 and you buy it back at 100. You make 94 if you sell something at 94 and you buy it back at nothing. Okay? Like you sold the game and they never picked it up and they let you keep all the money. Okay? Like that's the only analogy I can come up with off the top of my head. But you get to keep it all. It's all yours. Okay? So don't buy the game, just treat yourself. Whatever. So sold it. It expired at 0. Now we know we're not going to buy it back because nobody's going to buy it at 0 because they, like, nobody's going to sell us at 0 because they'd lose money. But that's the expiration, the settlement value. It's always going to be 0 or 100. And like I said, I know that can mess with your head a little bit the first time you hear it. But just think about sell high, buy low. Okay? You want to settle lower. So you get your $94 of max profit, and you can get your $6 of risk returned back to you. Okay? Now notice we're moving back over here. Now we're like 102.51, 102.52. Okay. Now this is very important. As a scalper, you need to understand what just now happened. Where'd all the quotes go? Okay. Market makers can pull out of the market before expiration. They're allowed to because, how are you going to price this 0 or 100 contract in minutes to go? Okay? And remember, we don't want them to make all their money off of us, but we want them to be profitable enough to stay in business to make a market for us tomorrow, so we get in and out of trades. So if you see quotes in there, it's other traders placing quotes. Now, the market maker might decide for whatever random day to go ahead and place some. They might decide to do it. But you should not expect to get filled in the last 2 minutes before expiration. Okay, there's 2 minutes to go till this thing is going to expire. So you should not expect to get filled. So I've got 1 minute and 3 seconds, 2 seconds, 1 second, tick-tock. So if you had a contract that was at 102.50 over here, would it be wise if the market's like at 102.51, 102.52 to hold on to that thing into that 2 minute dark zone where you don't really have the ability to get out of the trade? Is that a wise choice? The twilight zone, the danger zone, the dark zone. Okay, so it's just important to understand that because that can cost you a lot of money if you don't understand. Well, I thought I was going to be able to get out because it was really close, and so I was going to watch and I was going to get out of the trade, and that's great. So now people are coming in here, they're trying to buy for 50. Maybe they sold for 50, they're trying to get out. They're trying to buy for 90, see if somebody will give them a free $90. Okay. Also, they're demo trading. Boom, done. 102.53. Settlement email will come out here in a second. Okay. And so the demo trading can look really real, but there's live and there's demo. And by the way, you can always verify trades, whether they're live or demo, by looking at time and sells over on Nadex. So we're here on Nadex.com. If you ever want to verify a trade, if somebody calls out, whatever, see which one it is. Time and sells. Every trade. Right there. Okay? Listed out. Timestamps and all that. So timestamps should be able to be provided by anybody. Anyway, so definitely something you want to check out. But yeah, we'll just drop them right back down. You may have made the full money. You may have made all $50, but you were sweating. Okay? So, and that's not going to make you. What's going to happen is it's going to work. Okay? And one of the things I tell people, especially when they're scout traders, like, but any trader, is one of the worst things that can happen for you as a trader is you do something that you shouldn't do and it works. Because what happens when you do something you shouldn't do and it works? What are you likely to do? If you get rewarded for it, you're going to repeat it. My aunt's a psychologist, social worker, and she works with, all sorts of kids and everything, and she works with their parents, and she's like, rewarded behavior will always be repeated. And so, like, you sort of, like, it's not a good thing when you get away with it. Now, every once in a while you get stuck in it, okay? And there's just nothing you can do. you make a mistake. But I'm talking about the on purpose sitting there like, oh, I really want to make money on this, or I don't want to take a $20 hit, or whatever. Yeah, well, you're going to take an $80 or $90 hit or a $70 hit, and it's going to have. You just gotta learn, and you're going to learn one way or the other. You can learn wisdom from mistakes I've made, and many other traders that can attest to that are on this webinar, or you can learn from your own mistakes. I guarantee you, one of the two is a lot cheaper than the other. Okay, get out of trades before expiration. I have seen markets fly 20 ticks the other way in the last 2 minutes. I don't care how in the money I've seen them far further than that. I don't care how far in the money you are, it can always go back the other way. So we had that oil trade. Let's see, what was that, like 230? You can't really see it on here. I need a minute chart to really show you. But the chart's a lot cleaner. But, I got this, like, basically I had the signal on, and it's like, hey, go long, market should bounce up from 11 to 3 based on, seasonality, all this stuff. And I got it long, but I also had a short, and I'm like, I have conflicting signals. It's bouncing around settlement. And I mean, this wick right here, really, this is the expiration, okay? And, so this is what's happening here in, like, the last few minutes. I'm like, we're out. $90, get out. And flew back up, maybe somebody got 70, maybe they got 50, maybe they got 90. I don't care. I wanted out of the trade because it wasn't doing what I expected it to do, and I didn't want to be stuck in that last 2 minutes. And, I mean, look at how far it went. What if you were short? I was short most of the day, right? What if you're in this trade and you're feeling really good? It flies down here, nice 11 tick drop. You're close to the end of the hour. There's only 6 minutes left to go. And, but in the next few minutes, let's see here. This is literally the entire move. Okay, in the next 6 minutes, it moved up 30 ticks. 30 ticks in 6 minutes. And, it's just, it can go that fast, easily. So, I want you to be aware of that. So, it doesn't mean it's always going to work out for you. Obviously, there are no guarantees in pretty much anything. But, control what you can control. And at least you can limit the loss. And, yeah, you may have made money. Don't go back, oh, man, I would have made money, Yeah, but you also could have lost a lot. And we have a good tendency to remember all those profitable trades and forget about the the losing ones. So, all right. So these are got binary value determined. Binary value slowest to fastest. Okay, this is a really cool thing. I've been a option trader for 10 years now, and so we've been working on applying a lot of my option strategies that I've been doing. I have like 70 option strategies. We're working on going through just testing them all out and figuring out the best way to put them together. And so I started looking at more advanced stuff, and I don't want to get all into theta, gamma, delta with you in extreme detail. But basically, a binary, the short answer is a binary moves faster. Okay, the closer you are to expiration. All right, a binary moves faster the closer you are to expiration. Everybody got that? If you trade it, because think about it, here's what has to happen. It has to end at either 0 or 100. And if you know anything about options, if you don't, it doesn't matter. But if you know anything about options, a binary is a delta. Delta has to be 0 or 100. 0 or 1 at expiration. Okay? Same concept here. They actually line up perfectly on price. Delta of calls on ES with with the price of a binary on the S&P on a weekly. We can put the two side by side. And they move faster the closer they get because it has to be 0 or 100. And so what I'll do is we got so much movement. Let's see if we can... This actually may work. There we go. Okay. So what I'm doing right now is I got the euro dollar up, and I'm comparing the 38.60 strikes that are going to expire over the next 24 hours. Okay? And even several days. And you're going to find out some really interesting stuff when you start looking at this. And it's going to open your eyes a lot. to what's possible with the binaries that you may have never even thought about. If we start looking at the further out expirations on the contracts, I want you to notice right here, there's a 4-hour difference in these, okay? 11 and 3 a.m. These are all the 3860. They're all 3860 contracts, okay? What is that difference in price? Look at that. $34.50 and $6. If I held this contract and the market, let's just say, stayed flat for the next 4 hours, if I bought it, okay, I would essentially lose about 28 bucks. Because it would be worth $6 4 hours from now. That's a pretty massive decline in value. Would you agree with that? And this is what we're all afraid of on out-of-the-money binaries, right? This massive time decay. Okay? So, you see that big difference in price. It loses a ton of value. But look what happens if I go out to 10 hours. I only lose $6 in 4 hours. So 4 hours later, instead of having 10 hours and 51 minutes, I have 6 hours and 51 minutes. This goes from 41 to 35. I only lose $6. Same contract, different expiration, but it decays slower. That time it decay is much slower. Notice if I go down here. Well, instead of losing like $6, I only lose a couple dollars, 50 cents an hour. Remember up here, what did I lose? Well, that's like 28 bucks, so I lost like $7 an hour. Here I'm only losing 50 cents an hour in time decay. I go down here, it's the same price. I don't have any time decay. Between 1800, like basically between 3 p.m. and 11 a.m., I can get the 3 o'clock expiration for the same price I could get the 11 a.m. expiration contract. So, if I wanted to buy an out-of-the-money binary, meaning a binary with lower risk than 50, okay? A binary on the buy side that would be, obviously, the market has to move up. And I just wanted to trade time. I just want to trade directional movement. And that was my big thing. I want directional movement. And I don't want to worry about time decay. I may highly consider choosing the 3 o'clock instead of the 11 o'clock. I get it for the exact same price. There's no time decay. You go out here, there's about $1.50, okay, on time decay on the one that's at 7 o'clock. Just the implied volatility built into it. And if you're going to flip your lid, go down here to Friday, and it's actually cheaper to buy the 3 o'clock on Friday than it is to buy the 7 o'clock on Tuesday. So you start seeing like, wow, I can actually get options further out in time that don't have time decay affecting them. Now, do they move as fast? Will the price change as fast? Yes or no? If I'm out here, will this move slower than the one that expires like in the next, couple hours? Who can tell me what moves faster? The ones that are closer, the ones that are further away? All right. So closer moves faster. There we go. I got to make sure a few of you are there. Okay. So closer moves faster. Now I can go up here, I can simulate a range, and this is sort of cool because maybe I'm scalping, right? And I can actually look out and go, what if I, want to call a 20-tick move, a 10-tick move? How much would I make on that contract? And I can start going out and seeing how much I would make. What would be my return if it was, going to move pretty fast, a scalp move? And I can go down here and go, well, if I bought this weekly, basically says I wouldn't make anything. Okay, I'd make like $2 on the trade because it moves so slow. It has 3 days to expiration. It's got a lot of time to get to 0 or 100. Okay, and I am simplifying it, but if you get that, you would already got it. Okay, I go to the one expires here basically in 23 hours. 45. I make $21. Okay, and I got till 7 o'clock tonight. not too bad. And if it takes 4 hours, I'll only give up like $1.50 in time decay, but it's going to move faster. So it'd actually still be worth. If the market moved up 20 pips, it actually still would gain value because it actually is going to move faster. And look at this one right here, same price, basically same, give or take $1 at the same profit, like one more dollar here. But we're talking $22, $24, $25. Now here we're going to start making some money. $34, $35. Okay, on the same 20 pip move. Now this is not accounting for time. Okay, that's why we're looking at how to get rid of time potentially. So for $35 right there, I'll make $35 on that one, and I'll lose about $5 in time decay over the next 4 hours. But most of my scalps are not going to take 4 hours. Right? So you can start looking at that, just that simple concept to figure out what might be the best contract for you to trade. You may decide that maybe this is it. It has the least time decay. I'll get this. I'm like, well, it better move fast, because if it doesn't, it's going to suck all the value out of it. Okay? But if it does move, it gets me in the money, well, it's going to be worth a whole lot. I'm going to make a fortune on this contract. I mean, $91. So you'll be like all excited, right? If it moves fast enough. But what if it just stays really slow, it doesn't move that much? You don't have to get destroyed on the contract. You can just choose a further out contract. If you want to trade a directional strategy, and you really just want to trade the direction with a limited defined risk that you can trade on Nadex with the binaries, this is a way you can do it. You can use this to sort of get that whole time out of the equation part and just trade directional and give yourself time for the contract to move. Now, it could move against you, etc., but you can also define your risk. You might now go, let's see, 2.5 to 1, 3 to 1. I may just risk 25. Okay? You're like, I risk $25. Am I going to make enough on this trade? What, am I going to make anything on the trade? Nope, not that one. What about right here? Wow, I can make twice the amount on that one. And it'd still be worth $18. Well, that one's $6 and $6.50. So now you start seeing like maybe where the best potential profit is. I might decide instead of buying a 43, only if again, this is getting rid of the time decay aspect. Okay, I could buy two of these 18s for $36, less risk, and make $36 in a 20 pip move. If I bought a 43, I'm only going to make 23 in a 20 pip move. Okay, do you know what I'm saying? Risk $18 twice. That's $36. Okay. So instead of making 18, I make 36. So I make 36, make 36. Here I risk 44 to make 22. And you go, well, yeah, but that's out of the money. So if it doesn't move, it's going to kill you. Well, no, it's going to be worth, actually, this is going to be worth more. Be at $18.50. And it's just using the price ladder. So this is a live contract. Okay? So if I was the 38.80 right here and the 38.80, 18.50. Time is not going to hurt me. Okay, on this trade. So I might decide that is a better use of my money to trade directionally. Now, this isn't 20 pips in 4 hours or 20 pips in a day or 20 pips in a week. Okay? It's just 20 pips. If I move 20 pips, right now I make $18. I make $20 actually if it happens in 4 hours. Okay? So if I go up here, still net I'd be at 37. So I was trying to get at 37, 39, 37 right there. And I can literally track this all the way up. And you start practicing at this a little bit, using the scanner here, using the simulator. Then you can pull up your chart and you can decide, whatever contract it is you're trading. I got a trade over here. I want to go short. Okay, so let's go short. I want to go short with defined risk. Okay? And so I sell. And let's just say it takes... to move, this is a move of, here, let's see, let's use the ruler. So get the arrow right there, it sells down, and let's say it's right there, that's 24, that's 20 ticks. And that took about an hour to move 20 ticks. Because I'm going to use out-of-the-money contracts and have lower risk of actually using the further out in time ones. And it seems so counterintuitive. But when you start seeing that lack of impact of time decay and that you can still get that move, then you can start bringing up FX charts, different charts like that, and putting all the different pieces together. And open up a whole new world of scalping trading opportunities using the out-of-the-money binaries. Now, you can also do shorter term. If you do shorter term, then should you be going for, think about this. If you're doing a shorter term contract, an out-of-the-money contract, it has to move, right? It has to get there. Is that accurate? Like if I buy an out-of-the-money contract, it has to move for me to make profit. I can't make money if it just sits there. Does everybody get that? So it's going to have to move. So am I going to want to have a big move if I'm going to use a shorter term contract, or a small move if I'm going to use a shorter term contract? If I'm scalping. Yeah, small move. Okay? So if I'm going to use a short term binary out of the money contract, I better be going for a very small move. Like one, or you'd be pushing 2 strikes. Okay? Out of the money. So wherever the market's at right now, like 1 or 2 strikes. And when I say strikes, like what are the distances? Like right here, they price like euro, dollar, and tens. Okay? On these intradays, and I mean the intraday strikes. Like 10 ticks out of the money, maybe 20, and again, that's pushing it. Like that's a scalp. Okay? Like 1, 2 strikes would be, you're starting to really get into why are you doing that, and why aren't you going further out? Okay? Because that should be sufficient. It ought to make 20 if it moves that far. But if I'm going for a little bigger move, I should be using a further out contract. Okay? And so I'll go over here, and if I'm going for a bigger move, I can use a further out contract. I can trail it. I have less risk on the trade. I have more time. I can go over here and start trailing it down. Maybe I should let this thing expire in the money. That was a nice big move. So what I'm trying to do is sort of like, twist your brain up a little bit and let you see that there's a whole new world of binaries you haven't even been looking at. Because I know what you guys are looking at. I'm training you, I'm teaching you, I'm working with you. We're all looking at these trades. And there's just a whole different world. Now, you don't have to be looking at weekly charts or daily bars or 4-hour bars or whatever. Okay? That's not what I'm saying. I'm just saying that you're picking the right binary to do your scalp. Are you scalping price? If you're scalping just really small scalps, like 10 ticks or 5 ticks, that's a close-term binary out of the money. If you're scalping bigger moves, and it's like, well, bigger moves at a scalp, well, 20 ticks can still be considered a scalp, okay? Then let's go ahead and choose a further out contract where time decay is not going to affect us, just in case we're wrong and it doesn't really move as far as we thought it was going to, okay? I'm over here, I'm trading the Russell. We had a lot of Russell stuff going on this morning. And you got to have a nice, right down, nice right up on the contract over here. And, you could have chose one that had more time. It actually, had that in your favor because it took some time. I mean, from move here, like 11 o'clock, took 2.5 hours. For it to, move this distance. Now, this is a good distance. It was a solid 25-point move. But if I want to go for that kind of move, I want to use out-of-the-money binaries. Yeah, man, make a lot more money. Okay, well, then you need to choose ones that are further out in expiration. And again, I probably wouldn't choose something 25 points out. That's ridiculous. But I would still want to choose, the more time you got, you can neutralize that time decay. And you'll notice when that neutralization happens, if you look over here and you'll look at the price ladder, you'll see that neutralization when you'll see the big difference, the big drop off in price. Like, okay, it's starting to happen. Now it's happened. Okay, like now we're losing like 70% of our value. Here we lost like 25%, and then here we lost like 2.5%. Or whatever. Not even that. So like 5, maybe 5%. But whatever the number is, it's a very small loss. Here we didn't even lose anything. So this area right here, no time decay issues. Now let me see where I can get the best bang for my buck. So, okay, well I can actually get quite a bit on that one. right there. So like these are my best contracts. I made a choice to drop those off and actually choose the cheaper binary contracts without having time decay kill me. Okay? That doesn't mean go in and risk $70 like you would have out of the money. Go for the same profit. If you usually go for 20 or 30 bucks and risk 20 and go for 20 or 30 bucks, it doesn't mean you go risk 70. Now, if you do decide to do that, then now you're going for 70 bucks or whatever. You could make it a lot more money. Okay, so short-term binary scalping, meaning very small, like super tiny scalps, okay? That's your close out of the money expiration. Long-term binaries out of the money are great for your little bit bigger, like maybe 2 strikes wide at most, scalps. So 1 strike or less, short-term, 2 strikes or more, long-term, okay? And then what I'd look at is in-the-money binaries. So in-the-money binaries are ones that make money on time decay. On the time decay side of things, remember it moves slower. So would it be advantageous for you to be using time decay on contracts that don't change in price with 4 hours in time? I see people do this all the time. Some forum I posted in, some trader was talking about this, and they're like, yeah, I'm going to do the dailies, and I'm going to go ahead and put these trades on, and like you can put them on at 6 o'clock, or going to put them on at 8 a.m., or whatever. And I'm like, I was trying to teach them some stuff, didn't want to listen, but I'm like, maybe you want to look at where the time decay kicks in and then throw your contracts on. So why even have the risk of a butterfly, like say a daily butterfly, or, we have those on our site, we talk about all that. Why have the risk of a premium collection trade when you're not collecting premium? $2, not worth it. Nothing. 4 hours, no change in price. Yeah, not worth it. $1.50, not really worth it. $4, not really worth it. 38 to 12.50, now that's worth it. 6.5 hours out. Okay, that's where I'm looking for ones that expire 6.5 hours out. Then I get some good premium, and I got a good chunk I'm going to get back. Okay, so you see where does that time decay really kick in? Now that is time. That's 4 hours. Okay, so I do realize that reality. That is a 4-hour time decay, but this is a 4-hour like $5 decay. That's a 4-hour like $1 decay. That's a 4-hour no dollar decay. So you definitely don't want to be doing time decay further out than where what's called theta time decay kicks in. Okay, so you're in the money. Just think about that. Don't go further out. Like people go, I want to do a weekly neutral strategy. I'm like, no, you don't. Like weeklies make no sense, that far out in time, because you actually get less money on the weekly if you were selling this thing. Right here, I'll go up here. I'll put the buy and sells on. If we go down and we look at this, let me do in the money and out of the money. And we look at this weekly contract way down here. 44.50, 38, 36. They're giving you a little bit better. Now it's 37, 38. For 3 more days. Okay, so check this out. If you're actually selling this for time decay, so you're selling it because it's below where the market is right now, you're going to make $37 on it. Okay? This one right here, you're selling for 38. So you're telling me that you're going to take on basically 2 more days of risk of the market moving against you for $1. 2 days of the market. What can happen in the next 2 days? The Fed funds rate, the ADP NFP report, the pound, dollar, and CAD GDP reports coming out can all happen in the next 2 days. And you're going to take on all that news at this point now for 50 cents of extra premium collection. So looking at where that time decay kicks in is huge for determining when the optimal point is that you want to actually do a strategy like this. Okay? Now, is more of a time decay than what I would call a time scalp. Okay? A time scalp would be where I'm really maximizing that time decay. Okay, I go in, I buy a contract for $70, you know, $80, and it just drops to nothing in a heartbeat. Okay, I mean, just a few ticks in my favor, and I bought it for 70, and it's already, you know, at 90. Okay? Now, if I go in and I buy this contract at 85, and this is like, remember I talked to you about the price, what should you expect to get out at? This is probably one of the most important lessons if you do want to do like short-term trading that you need to learn. So if I go up here, let's hit refresh on this. Go to Forex, go to US Yen, we'll go to 9 o'clocks. If I buy this, what to say? I'll sell this for $28. Take profit for whatever. Okay? I want you to notice a pattern that's happening. Do you notice how the bid size and offer size gets really small out here? Would you like to know, like, because maybe you bought 20 contracts or you sold 20 contracts, you want to buy them back at $8 or $9 or whatever it is. Okay? You want to get out before there is no bid-ask spread. Meaning that there's basically on this, you know, naturally about a $9 bid-ask spread on this contract. I mean, it's a 9 p.m. US Yen. There's not a whole lot of volume happening. So if I sell this contract for, well, it was 29, now it's 20. Talk about decay. I'd probably want to buy it back at 10. If I had more than 5 contracts on there. Because I was actually on the radio with another trader I do a show with on Friday mornings. And he was like, I'm in these contracts. I can't get out. And I'm like, because he had such a large position. He'll get out of pieces at a time. And he didn't overdo the market. It's just there was only 5 quoting. And like if you take all 5 out, they'll put 5 more back. Okay, but it may take 30 seconds. It may take a few minutes. Now with the new market maker, that'll be faster. But I want to get out if I have size. You know, it probably won't really affect you if you're doing ones, you know, to a point. But when you start getting to like 10s and 20s and 100s, okay, I want to get out before there's no bid-ask spread. When there's no bid-ask spread, meaning when the price is so low that there is no bid, that's when the offer size drops. So if you're a larger trader, get out before then. Figure out what the bid-offer spread is. Okay? And make sure you're out before that offer goes from like 1 to 0. Okay? Or else you're going to see the size drop down. Very important if you're starting to trade some size. So you won't notice it first, but eventually, you know, hopefully, you will definitely notice it. All right, so we got how time affects a binary. We got, which gives you a variety of ways. We talked about out of the money. We talked about in the money being closer to expiration. So I'll go in and, you know, for instance, I'll use, and I guess I'll skip around a little bit, using volume and movement expectations. There's a lot of ways to do this. What I'll look for is when a market's breaking out, like the Russell's just rocking today, right? And these are expected ranges. Like how far should the Russell move in an hour normally? Like this is what I expect the Russell to do. If it breaks outside of the channel, and I actually use the channel on this, if it breaks outside this little red channel, that's the open to the low of what I expect the Russell to do. And normally, it stays in there. But if it does that with volume that's higher than expectations, and we even use futures volume on Forex. We use the Forex futures volume to actually have Forex volume, real Forex volume, not tick volume. But if it breaks out of that with higher than expected expectations, and then breaks that low, I'll go in for a scalp. And it looks really small, but, you know, if you know the Russell, if we just look at that right there, that's a couple points. That's a strike. That's actually a couple strikes, right? During the day, because they're only a point wide. So I'll go in, I'll grab some scalps. I don't know if I plotted that right, because we actually go all the way back here. There we go. It's like I thought that trade was bigger. Here we go. All right, so 2.8. So easily you got your 2 strikes on that trade, if you happen to have done. So right here goes down, but see, I didn't break expectations. Like the little orange line expectations didn't break the volume. There, it didn't break the volume. There, closes back up inside, okay. But it turns around, closes back down, and is breaking the volume again. Got another one, got 5 points, okay. So that could be an out of the money, only going for a couple points. Or it could be an in the money. Current hour, okay. Collecting premium, time decay. For say, buy for 30, sell for 7, or buy for 70, sell for 30. And big thing is I want to get in and I want to get out. That's the whole point here. Okay, don't go into this trade and you're like, it's breaking out. Sweet, I'm going to ride it to the end. Okay? No, because guess what? The end minute went against you. All right, so it goes down. That's nice. How far to go? 3 points. Okay, so if I were to get out 2 strikes later, because they're only 1 point wide on the Russell. In, out, 2 points later, make a nice profit, move on, next trade. It's scalping, okay? So, it's not like greedy ride it to infinity and beyond because I have an out-of-the-money binary and I have low risk. Or I have an in-the-money and I may have high risk. And even this trade, this thing took off. You're just banking it. Ooh, came right back, okay? So, what about 5 points right there? Just simple momentum breakout trades on binaries. Very, very simple scalps. Okay? And, they don't happen all the time. I don't always expect it to break out. That's just one example. Okay, now that's a breakout momentum trade. I could actually do these inside. I don't even care where they happen. I'll do them inside the box. Okay? If I go over here and this thing's moving up, you see this thing running, boom, 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 all of a sudden breaks expectations, I'll go grab a couple points. Done. So, broke expectations. Okay, I'll take it. So, right there. And just, rinse and repeat. Okay? You can do these all day. The breakouts don't happen that often because, again, that's the expectations. But inside there for just a couple quick points, again and again. See how they're inside there, but they're going. Every time that breaks volume, that's another trade. That's another trade. So, lots of trades happening. And you can do it on short-term time frames, long-term time frames, whatever you want to do. So the last guy we have out-of-the-money contracts. At-the-money contracts. At-the-money contracts, if a market is at the strike price, it's at the market. It's at the money. What is it going to be worth if it's at the money? Who can tell me? The market is currently trading at the price of the strike. It'll be worth $50. Exactly, Kenny. So, that doesn't matter if there is 5 days, 5 hours, or 5 minutes till expiration. If it's right there, it's going to be worth $50. Give or take, a little bid-ask spread. The mid-price should be right at $50. And so we go down here, we'll find one. We find one that's right in the middle. Eventually, maybe not. Here, we'll go up here. We'll find some on the dailies. Okay, right there. So, 1866, the market's at 1867. Okay, so it's a little bit higher, so that's why it's a little higher than 5056. See if I'll get 4753 if it was actually at 1866 on the S&P right now. It's at $50. This gives me an edge. I think this is one of the number one edges in a binary contract, is I can count on that $50 price. Now, I'll call it you can call it 47.53 rule for the bid-ask spread. You got to look at the bid-ask spread on it. You can call it the 43.57 to give yourself a little extra room. But if I buy a binary at, whatever price, I know I can count on it. Let's say I buy an out-of-the-money binary. I can count on it being worth approximately $50 when the underlying market hits that price. Okay? So that gives me a really good target on exit, potentially. Now, I may also go for 2 strikes. I may be really happy to go in here and grab a contract and grab out, buy at 29 and sell at 50 and I'm happy, or maybe I bought at 22 and I sold at 41, or maybe I bought at 14 and I sold at 32. Okay, or 24 here, or maybe I bought at 11.50, I sold at 17. Whatever it is that you did, but you can use the binary scanner to help you calculate out that best contract to choose. But I can count on that 50. I can also count on that 50 if I'm doing it in the money. If I'm doing it in the money, I'm risking at $70 to make 30. I need to have some risk management because you know what? You may get on this streak. You may go a week. You may go a month. I've seen traders go months, like 3, 4, 5 months. They think they are the kings of Wall Street in Chicago. They got both towns ruled. They're owning it all. And they're going to go out and they're going to provide services and everybody's going to pay them. And in a week, it's boom. Okay? Because they blow up. You got to take profits and you got to manage risk. You can't just hold. And so, if I buy at 70, let's say I bought this contract right here. Market 7 points above it. Okay? I can make $28 on this contract. Alright? $27.50 on the contract at this moment. If the market fell 7 points against me, what could I get out at? Could basically get out at $50. So I can have a reasonable expectation, as long as I will manage my risk, that I could be risking about $22.50 for a maximum of $27.50. Now again, I don't necessarily expect to hold this to expiration. So, realistically, I'm like, hey, if I buy it and I sell it, probably about $94 is the best I'm going to get right there. So 72 to 94, that's going to give me $22.50. And I lose, $22.50 if it goes against me. That's not bad. Okay, now I'm in a 1-to-1. By understanding that $50 principle when the market hits the strike. When I do in-the-money binaries, that is usually a very, very, very strong rule. Exit, win, strike, hit. And I do have a couple of strategies I do where I give it a few ticks based on what there's more to it. But I make it like 3 ticks beyond the strike. But you really don't control that. If you have less than a couple hours to expiration, you don't really control that out of the money binary. So once it goes past 50, it can just drop from 50 to 10 in a heartbeat. Okay? And so that's why I like to get out there before I lose control of the out of the money binary, which can just drop on me. And it doesn't take too many of those to wipe out some good profits. So that's the 1-to-1. We talked about volume and movement expectations. We have webinars every Thursday if you want to learn more about this. I'm going to be talking about this even more. Feel free to join us. Just hop on our website, register, and there's a free weekly webinar button on the right side of the page you'll see. We talked about scalping intraday and daily binaries. So daily is the ones we're talking about. We're using a little bit longer time frame for a little bit bigger scalp. Talked about out of the money, at the money, in the money. Talked about what moves fastest, slowest, and how you determine the value of a binary. And then let's see here. Okay, Eric asked me that over on our site. This is a Nadex one. Okay. But yeah, if you want to get out at about $50, you want to get out at the when the market's at that price. Let's see here. Do we have any questions? I think I got most of the questions. But are there any outstanding questions? Hopefully I taught you a few things, new or experienced, to look at. And if you're wanting to learn how I do it specifically, then feel free to hop on over to our website and be glad to help you out. What about, when attempting to scalp small moves, how do you determine a reasonable profit target? And Samuel, I'm thinking you're thinking like a pretty short, small move, short time frame. Is that right? Okay, so what I'll do is I'll literally go over here and let me open it up. Because this is just the fastest way to do it. And because you're probably consistently going for maybe 10, 20 ticks, whatever. Let's just say you're doing euro dollar, and I'm just throwing, I don't know what you're trading, but I'll just literally hit like simulated range, 10, hit OK, and it'll update the price and update what it's worth. So let's get a little more liquid something, or whatever, but here, we'll get rid of euro dollar, go to like US yen. So I can see really quick, like, okay, so let me simulate a range right here. I'll hit simulate, and then I'll type, say 10 ticks. And it is important to note that I don't really scalp spreads. I'll use spreads to help me scalp futures. But I don't really scalp the spreads. They don't move fast enough. I want that speed or bigger moves. So that will tell me basically what will this be worth if it moves 5 ticks, 10 ticks. And you'll be amazed. Like the at the money's can move like $35 in just a little bitty movement. They can actually have pretty massive moves. I mean, like right here, check this contract out. 56 by 66. I mean, you're going to make, let's say, $29 if it moves up just 10 ticks. Okay, right here, if it moves down 10 ticks, it's telling you to make 48. That's just a 10-tick move. That's awesome. So, I mean, at the money can actually have quite a bit. Now, that can be good and bad for you, right? Because it could go against you in only 10 ticks. So, you might decide, well, I really like that, but I like this even better. So, if it's faster, you know, like obviously the return is better here. You could go even further out, but it better be really fast because it'll just decay on you. It'll like really decay on you. So, you know, 22.50. Okay, hey, I can make $66 on a 10-tick move, or maybe I only want a 5-tick move, which is not anything. Okay, so I go over here 5 ticks. All right, 22.50 for 14, 8 for 0. I don't make anything. Okay. 66 for 56, or for not, like, yeah, I mean, so there's not a whole lot being made right there. And so you would actually look at the goes, go, can I realistically make the profit I think I want to make on the move I'm going for? And if I can't, then either I got to figure out a system that's going to go for a little bit bigger move, or, you know, figure out a different strategy, or go the opposite direction, or whatever. Does that help out, Samuel? I use a simulator. It's basically reading the price ladder. It's doing a little bit more than that, but it's pretty much reading the price ladder. And which you can do it if you've watched it enough. You'll go, okay, well, up 5 ticks, down 5 ticks, but it's doing it in fractions. So it'll go in fractional moves to give you a little more accuracy in the reading. All right, how do you... If I want to do scalp inside the channels versus just outside them, like on these flat days where nothing's happening, right? Like this day is like just a boring day. Okay? I mean, today was not boring, but like the 16th last week, boring day, or a couple weeks ago. I look at exceeding volume, so I wait till I got it, boom, got it, and then I go and I grab like 2 points. Current hour, really short. I mean, you got to be ready. It hits it. Lose a couple points, you're out. And so I'm just lining up bar, closes down, exceeds volume, breaks low, short, get out like 2 strikes later. And, you know, basically I wait for it to reverse. Because, you know, I expect these to not keep going forever, right? So I'll take the trade and then it'll pull back. And so I basically just watch the oscillations. And, you know, like, see like right here, so the MVP is going short, and then long, and then short, and then long, and then short. So I trade with the MVP on that to help out. And I prefer, honestly, out of the money contracts on it, because if it goes against me, it doesn't hurt as bad. And I make the same amount of profit. And I can just set it and set my take profit and move on to the next trade. Versus having to worry about the risk management side, because I've already capped my risk. And I can't get stopped out and go against me, and it can come back, and I can still be profitable. Let's see. So would you suggest looking at 6-hour butterflies instead of dailies because of the difference in time decay? Yeah. I mean, now, by the way, what I want to tell you is don't just go pick 6 hours and make that some rule. Okay? You need to look at that specific market. And, you know, let's say you're trading the S&P. Okay? Let's say you want to do butterflies on the S&P. Go in and, I don't know, set up Bandicam or set up Camtasia or something, you know, record the prices every hour. Or just record 24 hours or whatever you want to do, but look at what the prices are. You know, it's easier with Forex. They make it really easy for you because you can go through and you can look at 24 hours or really 4 hours apart. But you need to see consistently what are the when does that time decay kick in for that market? And when that kicks in, that's when you know you're sort of at that maximum butterfly width or maximum iron condor width, whichever you want to do. I like condors better more often than butterflies, but like maximum binary butterfly width would be right before time decay really starts kicking in. And it's like, all right, I'll give up that like little $6 or $7, but now I only have exposure for 4 hours, and I get the exact same strikes for only a few bucks less. I use these charts for futures, binaries, forex, spreads. I hedge a lot. That's my favorite strategy. Is I'll hedge futures with spreads. And then, yes, I definitely keep open. I always have open. I actually have 4-minute, and I'll do 10-minute analysis on volume. So I'll find out like key volume levels by using 10-minute analysis. We did some webinars last month over on our site where I go through and I teach you how I do 10-minute volume analysis for magnet pricing, and it's pretty uncannily accurate. You'll go do it, and then all of a sudden you'll notice it like just nailing those levels perfectly over and over again. But yeah, so because I trade both. So because I'll trade a reversal on this. I'll trade a breakout on this. So I call it boomerang. It's like the launch, the reversal, and then the continuation. So like right here, I'm looking for a reversal. I don't get it. Then all of a sudden, boom! I get a continuation. I go short. So like that right there is a trade. So probably would have saw the same thing. On this trade, what is this, 130? So I could go over here, probably go to 130, and yeah, they're the exact same trade. So I may have caught it faster, actually, over here, because these are tick-based, so I'm not waiting on 4 minutes to close out. Or I may have caught it over there just because of where the time happened to close. So but I'll watch both. I like having the perspective of price and time side by side when I'm trading binaries. So if I'm just trading, futures, if I'm trading spreads, hedging them, using like daily spreads or short-term spreads or just whatever I'm doing, I'm not as concerned about the time factor. But I do like seeing the time factor a little bit more, and boomerang is one of my favorite strategies as well. So yeah, so you could go in and Charles said, hey, I noticed you use the boomerang templates on 4 minutes, but yeah, so also I have the Apex chart up, and I'll use both. I'll go back and forth. So, it gives you a little more granularity. This one gives you more clarity. Would be about the best way I can put it. So this is pretty much like you're looking right now at the same chart. Right there. So they look about the same. Just it's a lot smoother on the trend, and this is obviously a smooth day. So, and that's the Russell and the yen, by the way. I don't know if you ever noticed the correlation between the two. Most people don't even look at those two. Like, you're like, are you looking at the same thing? It's like, no, those are two completely different instruments. But there's a lot of cool ways you can start mixing up stuff like that. And I'll even trade, I'll like spread them. I haven't even got into this yet, but I'll spread the two different instruments together. So, I go long one and, short the other, that type thing, because of how the difference is when they go out and come back. Part's called the correlation. So, not for premium collection, but actually usually more for it's like a cross strangle. Let's see, what tick size would you use on the yen? I don't use tick bars. Okay, the bars you're looking at are not tick bars. They are tick based, but as far as bars, let's see. I can tell you because I already have it all done up, and then we'll probably be wrapping up pretty soon on this. But for tick sized bars, I have them all saved in my templates. To open up and tell you, I think I have it memorized by now. We just did every quarter I go through and I re-review all my settings. I used to do it like every day. That was obviously not a good idea. And then weekly, and that was still too fast and like over optimization. And quarterly actually gave me a chance to really see performance and consistency. So Now, basically, every quarter, it's April, so I just stopped and went through everything again and reset them all. But the yen, 14. That's my preferred size. So, 14 ticks. All right. Do we have any more questions? Webinar's going a little longer than I know anybody expected it to. But I think we got them all. All right. Awesome. You have a great night. I hope you took a few things away from this. Feel free to come and explore it further and ask questions over in the forum. I'd be glad to brainstorm with you. Okay? It's fun figuring all this stuff out and putting it all together. All right. Y'all have a good one. Y'all have a great night.